2022 has been a year to forget in the stock market, and especially for Tesla investors. Ugh. Ew. And now we're getting to the point where certain metrics are starting to highlight the relative value of Tesla versus other stocks. The primary metric I want to focus on for this video is the forward price earnings ratio, or PE. And the most common way of calculating this metric is by dividing the current market cap of the company and dividing it by the next 12 months projected earnings that Wall Street is coming up with. If we go to Yahoo Finance and pull up the statistics for Tesla, ticker TSLA, you can see the current market cap for the company is $388 billion with a forward PE of 24.21. And this is the current valuation of the company based on roughly 50% year-over-year sales growth. And what's cool about that forward PE metric is that we can use that number to figure out what the market is expecting Tesla to earn in the next 12 months. If we take the current market cap and divide it by 24 forward PE, we come up with $16 billion of expected earnings in 2023, which is roughly $4 billion per quarter on average. Now, there are so many different ways of valuing how much a stock should be worth. There's price to earnings growth, so many different ones. But what's really interesting about price to earnings is that it's not just one of the most commonly used, but given today's market environment, it's making Tesla's valuation kind of stick out like a sore thumb. Let me explain to you what I mean. If we pull up the same metric for Apple, ticker AAPL, you can see that the forward PE for that stock is 22.17, and Apple is doing about 8% year-over-year revenue growth. Now, looking at Coca-Cola Company, ticker KO, their forward PE is roughly 25.25, with about 12% year-over-year revenue growth. Amazon, ticker AMZN, is at a forward PE of roughly 42, with an estimated 10% year-over-year revenue growth. Alphabet or Google, ticker GOOG, forward PE of 16.8 and 2.5% year-over-year revenue growth. And one more example, Pepsi, ticker PEP, their forward PE is at a 24.88, with a 9% year-over-year revenue growth. And so if we use this forward PE metric, you can see that the market is deciding to price companies like Coca-Cola and Pepsi at a higher valuation than Tesla relative to its expected earnings for the next 12 months. And so the question becomes, why? Why is this the case? This seems weird. If you've been following Tesla for a long time, you know that Tesla back in the day feels like million years ago, but it wasn't more than 2-3 years ago. Tesla had price earnings ratios of 700, 500, 200, 100. And this was because the stock market was pricing the shares very, very high relative to their next 12 months of earnings, with the expectation that in the long term, Tesla was going to reach a valuation that would warrant the earnings it's going to make in the future. But now we're in a situation where Tesla appears to be growing its earnings, but the stock price is coming down very dramatically, especially as of late. One of the reasons I think is the perceived risk of execution, meaning that the stock market as a whole is not necessarily convinced that Tesla is going to be able to generate long-term earnings that will warrant its current valuation, as well as some concerns around its growth trajectory and if it's going to be able to keep that up for the foreseeable future. If you're enjoying this video so far, I would love it if you throw me a like. It helps the YouTube algorithm show this to more people. Thank you so much. In other words, we can say that the market is perceiving reduced demand and reduced profits for Tesla. Now, there are many things that happen in the stock market, but these two articles from today could highlight some of those worries. Tesla stock tumbles again as China registrations falter, and Tesla extends shutdown at Shanghai plant in rare Christmas suspension. Even though Tesla is most likely going to report record deliveries in Q4 of this year, there might be some fear in the market that that growth will not sustain through the end of 2023, either due to pricing concerns, recession concerns, COVID concerns, competition concerns, what have you. Not to mention that there are other investments out there like Apple, Coca-Cola, Pepsi that provide dividends, which can shift the attention away from stocks like Tesla that don't offer a dividend to companies that do. And of course, we have to layer on top of that the Fed raising rates, which means that there are now investments out there that essentially have zero risk that guarantee a return. And so if you have, say, $10 million to invest and you can put it somewhere that's going to guarantee you 4-5% return, that is $500,000 per year that you're making by doing absolutely nothing with zero risk versus potentially putting that money in a stock whose perceived future looks unclear. So what's one way that Tesla can overcome some of these fears or unwillingness from investors to invest in the company? It sounds kind of simple, but you start by beating expectations. As a baseline expectation, if we use the math we did earlier, market is expecting Tesla to earn $16 billion in 2023, which is roughly $4 billion per quarter on average. If we compare this to the projected earnings for Tesla for Q4 of 2022, which are going to be reported towards the end of January, the market is expecting estimating between 425,000 and 430,000 deliveries, which correlate to an average of $1.25 earnings per share, which correlates to about $4 billion of net income for the quarter. We can say it a different way. The market expects Tesla's Q4 2022 earnings to be repeated 4 times for 2023. And if we take the 425 to 430,000 deliveries and multiply it times 4 for 4 quarters in the year, that extrapolates out to roughly 1.7 million deliveries in the year. And so question becomes, will they beat those expectations? And the one clue we'll get from Q4 earnings for Tesla is if they continue to guide for 50% growth year over year into the future. The 1.7 million delivery number that I'm working out to be the expectation for the market is roughly 25% growth on 2022 numbers. And so anything above that 25% should be a positive catalyst for the stock. And so of course I have no idea if that positive catalyst will actually do anything to the stock, but it's one way of beating the expectations of what the market expects to happen. But the more important question here is, what price earnings ratio will the market grant Tesla? Historically, the S&P average, which Tesla is a part of, has been about a 20 PE. And this price earnings could be significantly higher for stocks that are expected to grow into the future. And so it stands to reason that if Tesla can show a lot of growth into the future past 2023 and 2024, in theory, the market should reward Tesla with a higher PE than the average. The average earnings growth on the S&P is roughly between 8 to 10%. So if Tesla can grow above that, theoretically, it should warrant a higher PE. And this effect could be multiplied if Tesla continues to grow its earnings. If Tesla goes from, say, 16 billion earned in 2023 to 30 earned in 24 or 50 earned in 25, and they can continue to show a growth trajectory that's well above that 8 to 10%, theoretically, that price earnings ratio should be higher on a higher earnings base. But if you have a longer term horizon and you're willing to invest in companies for the long haul, it's times like these that could be very valuable for people to find opportunities that perhaps weren't there previously. But I would love to hear your thoughts. What do you think about the current valuation? What do you think about the price movements lately for Tesla and other companies? What do you expect for 2023 and beyond? Please let me know in the comments below. If you'd like to talk about this and many other topics with my awesome community on our private Discord, consider signing up through Patreon using the link in the description below, or signing up right through YouTube by clicking on join right below this video. And if you'd like to support the channel by purchasing merch just like the hoodie I'm wearing right now, consider doing that in the description below as well. Thank you so much for watching, and we'll see you on the next one. Take it easy, everybody. Bye-bye.